Let's get on. We have over 300 people on the line today. So I am joined by Kezia Samuel, our Chief Market Strategist, and I have to say, I am so glad we have a Chief Market Strategist here to help us all kind of figure out what this all means and kind of make sense of this. Let's just jump in. And I wanted to level set on the first slide here on this tariff timeline and what we've seen. So it's been quite a bit. So it was kind of started last month on February 4th, where we announced some tariffs, and then there was a pause. And then we were kind of on again, off again. So far, I think this is everything that's been official. We do have a bit of a pause in terms of the implementation of these tariffs until April 2nd. And this is specifically on goods from Mexico and Canada. So I think all goods that are covered under the USMCA are right now exempt for basically 30 days, right, until April 2nd. And that covers about half of Canadian imports and about, no, I think, sorry, 60% of Canadian imports and about half of Mexican imports. So think cars, auto parts, as well as a potash, which is a major ingredient in fertilizer. That's, obviously critical coming out of Canada. And that is a very major reprieve, I think, for Mexico and Canada. So again, we have a month to try to figure this out. And we are optimistic that there will be a lot of negotiations because as we'll show on the next slide, these tariffs impact people quite differently. And it depends on how much of your economy is based on exports, right? So if you look at the United States, you see that the United States exports about 12% of its economic output to other countries, right? So that's how much we can get tariffed, so to speak, right? If we have reciprocal tariffs. If you look at Canada and Mexico, you see 32% of the economy, 38% of the economy respective are exported. So I think that's kind of the first thing we wanted to point out is that tariffs hurt different people or other different countries differently depending on how much they export. The second thing that I'd point out is just thinking about the economic strength of each one of these economies is also a good thing to think about because if you're going to engage in a trade war and you know that you're going to take some kind of economic pain associated with this kind of negotiation with this trade war, it's important to kind of understand where your economy lies in terms of economic strength. And the U.S. economy, and this is all heading into this I think trade issue. The U.S. economy was forecast to grow at 2.3% this year in 2025. Canada 1.6 and Mexico 1%. So a big difference in kind of the relative strength in our economies vis-a-vis one another. On the next page, the thing that we show here is, and this is a study from the Brookings Institute, and we've done this ourselves as well, and we show very similar results. But if you look at the impacts of a trade war basically on growth and inflation, and as many of you know, growth and inflation are the major drivers of asset prices. So if you look at the impact on growth and inflation, which you show here, it's quite a bit worse for Mexico and Canada compared to the US. So I'll just cover this really quickly on the left-hand side. And I just focused on these light green bars. Those kind of assume reciprocal or retaliatory tariffs. So if you look, if we have, if we do have this trade war or kind of this 25% reciprocal tariff, US GDP can be expected to decline by about 32 basis points. So not massive in terms of the hit to GDP. Meaningful, but I'd say not massive. But if you look at Canada and Mexico, much worse. So over a 300 basis point contraction in US GDP, or sorry, in their GDPs because of a trade, because of this trade tariff. And then on the other side of the page, on the right-hand side, again, just focusing on those lighter green bars, definitely an inflationary shock for the US. So about up 80 basis points or so in CPI. And I kind of think of this as kind of like a full year annual CPI. So we often talk about a trade war for the US as being a stagflationary shock, and that's kind of what you see here. So lower growth, higher inflation, but both marginal is kind of how we look at it. And then if you look at Canada and Mexico on the inflation side, kind of a different story, but it all depends on basically what their CPI basket looks like and where they source it from. So Canada, if they have their reciprocal tariffs, could be expected to have a large increase in inflation because they import a lot of food goods from the US, and that's a large part of their CPI basket. Mexico, what we're seeing more here is that there would be basically a deflationary effect because growth is expected to decline so much. So that's the basic dynamic that we see from a trade war, at least at the 25% tariff level, in terms of its impact on growth and inflation. So, Kezia, what does all of this policy uncertainty mean for markets?
Yeah, let's take a look. In fact, there's a question here on, how are different goods that are being produced, American goods produced here, how will that get impacted by tariffs and vice versa? I think the complexity of understanding supply chains is that even in a car, it may be manufactured, let's say in the US, but parts have come from all different components across different countries. And so the complexity is it's quite hard to determine, which is why you've seen markets react the way they have. So it's not an easy answer, John, in regards to your question on identifying specifically what the impact would be. You'd have to look at each component within the supply chain and understanding how it impacts the good on an overall basis.
Yeah, and there are a lot
And
of things, as you know, Casey, right, that are car parts, right, that are manufactured
exactly.
here in the US, and then you ship it to Canada, and it gets assembled into a car in Canada, and it gets shipped back here. So it is a super tangled web.
Indeed. And then hence it's not an easy answer to say, okay, where does it stop and where does the tariff really get excised? The other part that I would just want to add on top of Christian, your segment, is this idea of reciprocal tariffs, which the administration has held on to, which also now is slated for April 2nd. That has a slightly different ramification. And I do want to hit on that just for a brief moment. And that is on the reciprocal tariffs, the biggest countries that are likely going to be hit are going to be countries like India, China, as well as some of the emerging countries, because you could recognize that the emerging countries have tried to make manufacturing more attractive. And so that's one area. The other part is that. That is also part of this, unfair trade practice. And if that comes into play, then Europe can also be impacted. So there's a whole host of moving parts. And the second part of the trade discussion, including reciprocal tariffs, brings in a new set of possible countries that would be impacted, just kind of broadening the scope as we look ahead. Now, having said that, what have the markets told us? And I really want to focus in on what's the signal against all the noise. You could see in just one single day, we have seen, we started with 25% tariffs, then autos got exempted last night. Then this morning we had, all goods under the USMCA for Mexico get exempted. And then before the end of the day, Canada was also included in here. And so what's the signal we're watching for? So let's start with the bond market. I think of the bond markets in some way as in my family. I've got 51 first cousins, if you have not heard my story. And in my family gatherings, it's always noisy, but there's always those wise aunties and uncles, and they kind of tell sort of a bigger story. So what is that saying? Let's look on the right-hand side. Let's take a look at the 10-year Treasury, and we've seen two distinct plays showing up. The first one is follow from that October time period where you saw the 10-year Treasury start to rise. This is just post the election. The concern was the economy was going pretty good, and the tariff worries were in the background, possibly igniting inflation again. And so you saw the 10-year Treasury rise all the way to 480, and then since then has retreated in 2025 on possibly hitting this growth concern coming back into play. So the question is, in this two-headed dragon between inflation and growth, which one will win? And so far, year to date, it's been sort of the growth concerns pulling back yields has been sort of on the forefront of many investors' minds, at least so by the 10-year Treasury. But is the concern widely spread? And here on the left-hand side, you can see what we've done is taken a look at policy uncertainty index in green, and you can see it spiked. But if you look at investment grade bond spreads, which is what do you demand companies to borrow against each other on top of that treasury yield, is you've seen that white line hasn't really increased. And it's telling me that, yes, it's modestly risen, but it hasn't necessarily spiked in the concern that the economy is going to go into a tailspin. So bond markets here sort of showcasing some growth concerns, but not necessarily a full-blown, recessionary worry either. As a result, year to date, bonds have outperformed stocks. And this is a reminder that having higher quality bonds is an important portion of your portfolio. So as we pivot into stocks, as we look ahead into the next slide, there's sort of a slightly different analogy or story coming up here. And so the bonds were my wise aunties and uncles. The stock market's like my noisy cousins. There's lots of us, there's 51 of us out there, and they're going to react to quite a lot of the chatter. And here's the first part. This is the S&P 500 since 2004. Sadly, trade wars are not new, but we are sitting, first of all, to give some context, on 2 consecutive years where volatility was fairly benign, and we just came from 25+% returns. Year to date, we have seen the S&P retrace about 7% from the peak, and year to date, we're sort of down 2.5% on a whole basis, just depending on where we close this today so far. But regardless, the last time we saw a 10% correction was in October of 2023. So just as a reminder that we're really sitting on some strong gains, and this volatility that we've experienced in the near term feels much higher, just given the environment we've come from. A couple of other nuggets to sort of keep in mind. One, if you look underneath, so let's lift the hood on the S&P 500 and look at the Mag 7, which we know basically was contributing 55% of 2024's returns and 65% of 2023's returns. That's where the pain point has been in 2025. Mag 7 down roughly double digits. Meanwhile, the remaining S&P 493 are in that flattish range. And again, rounding out for today's numbers as of today's close. And so what we've seen is it's not that Magnificent Seven stocks are at the heart of the tariff focus, but instead valuations told us that those stocks were priced for perfection, and that unless we saw those stocks have the same ability to grow in the future, investors are sort of taking a pause. So we are seeing value or dividend payers sort of do better in this environment. And again, that diversification story, which we started out with, still absolutely holds true. We've also seen larger companies, large caps do better than small caps, as small caps are much more sensitive to the economy. And should that slowdown become a true concern, we can certainly see small caps struggle in that environment. So having a preference for large over small. And perhaps the last surprising detail is international markets. International markets have beaten out the US markets for a couple of different reasons. One, they've been, I don't know how many years I've been talking about this, Christian, that international stocks are cheap and valuations matters. And I think in an environment, US stocks were very technology and price for perfection. Investors were sort of looking elsewhere. We've also seen some stories around Germany possibly rearranging how much they can spend, also causing that catalyst possibly for European equities to outperform in this marketplace alongside China as well. So I think the key message here, right, as I look at this, and if you can go to the next slide, which is sort of our talking points for clients, is you're going to have an environment where it's going to be noisy, right? However, we truly believe, as Christian mentioned, you've seen the back and forth. The tariffs are truly, we feel, are being used as a negotiating tactics. But you do expect volatility to continue as these negotiations continue. But it should not be enough to sort of derail the growth story entirely. We do expect a slowdown, but not necessarily a recession. Tariffs could reignite, or basically reverse the progress that we've seen on inflation. Again, which of these two-headed beasts wins really needs to be focused in on looking at the noise versus the signal. How should investors balance their portfolios? when there's so much uncertainty out there. I wish we could hedge out all the uncertainty, all the unknowns, all the risks. But in that environment where we don't know what's coming our way, it's likely that diversification, this tried and true methodology, is our go-to strategy. So we still have a preference for the US, even though international markets have done well. The catalyst, the last piece being, what would happen with those European tariffs still remains to be seen. But within the US, it is really important. We talked about diversifying outside those Mag 7s, where values were much more reasonable within fixed income. The need for quality bonds to balance out the stock volatility measures is an important measure. And then last but not least, should this inflation beast also resurface, including things that can balance out, whether it's risk control strategies and or even alternatives that can address inflation concerns at the same time, are all things that investors can consider in this time period. I think I've talked way too much, Christian. I don't know if there's any questions that have come in play and or anything else you'd add to this conversation.
Yeah, a couple of questions, Jen. There's quite a bit, so I don't know if we'll get to all of them. But you and I were talking about this earlier, Casey. It's what's the or say what does President Trump seek to achieve out of these tariffs?
Yeah, I know. I think at the heart of it, the conversation has to go back to what are we trying to achieve? And so the objectives we've heard so far are one, border control. And we know that, notice how we've pivoted. We went from China under Trump 1.0 being our primary objective to now much more of this Canada and Mexico, two countries that we share our border with. So border control, and the other part is fentanyl control, which to the administration is another portion. Now, both of these things cannot be directly addressed by tariffs. Tariffs aren't going to address directly immigration, but can be used as a negotiation tool to address those two concerns. The third is reducing our trade deficits. We've got a $2 trillion trade deficit, and wanting to sort of, maybe reshore some of the manufacturing where it makes sense and bringing back some of the manufacturing jobs. I think all of those are part of the end objective. And that's why you've got this moving target, which, yes, can feel like whiplash, but at the same time, knowing what we're trying to solve for sometimes helps in figuring out what's the end game.
Yeah, no, that's a great point, Casey. I think that's definitely in my mind the right way to think about it. And we to a certain extent 2018, 2019, gives you a sense, right, for what can happen. And I think you're right. Back then it was, let's try to fix this trade imbalance with China. And it's very much directed towards China. So what did US companies do? They had the choice to either reshore or nearshore, and they chose to nearshore, which is why Mexico and Canada are now, such the largest trading partners. We didn't see many manufacturing jobs come back to the US. So I think that's, it's just awfully hard, I think, to accomplish that here. And I think tariffs are a tough way to try to manipulate that.
Yeah, there's a question around, we've seen the markets pivot between no cuts to now three cuts, whereas growth concerns have taken over inflation concerns. Christian, have you seen the markets move since then? Is the current expectation for three rate cuts starting June, or have we changed since then?
We're still pretty close to that today. So we haven't seen a lot of move in terms of rate cut expectations. But I think a lot of this depends on how the Fed decides to look at the impact of tariffs. Now you can kind of listen to what the Fed, kind of leadership, if you will, has said about tariffs in the past, and sometimes they'll refer to tariffs as transitory, right? Because it's a one-time shock to prices. And if it's a one-time shock to prices, then does it make sense to alter your monetary policy to try to address something that just happens once? That's so far the majority of the narrative that I've heard out of the Fed. So this is both from the 2018, 2019 era, plus some of their more recent comments. And this is all unofficial, I mean, it's all on the record, right? But not within the Fed minutes or anything like that. So it is, to be questionable whether the Fed would alter monetary policy because of an upward shock in inflation, because of tariff. Now, if we were to see a downdraft in growth that was meaningful, then yes, I think 100% we would start to see the Fed move to cut interest rates. And that's another good thing is they, since they have raised interest rates to the level where you can actually meaningfully cut if you needed to stimulate growth.
What we have not brought up, Christian, is simultaneously as the tariff conversations are going around, there's the Doge cuts. Now, there's concerns that Doge cuts could possibly lead to a growth slowdown even further. And now we're seeing this recession word resurface again. What are your thoughts around that? Should the recession word be back on the horizon given the potential Doge cuts we have seen to date?
It's a great question, and I think it's why I think it feels noisier this time than it did back in 2018 and 2019. In 2018 and 19, it was mostly trade that we're talking about. Today, there's this flurry of activity. Right? I mentioned 76 executive orders on a whole range of topics, ranging from immigration to tariffs and Doge. I don't think it was executive order, but anyways, kind of a lot of noise coming out of the administration, and maybe I shouldn't call it noise. I'd say probably a flurry of activity, right, to start off the first month and a half or so. So when you kind of add everything up, it's possible, right, that the reduction in economic growth gets meaningful enough to move the needle on our GDP growth. So we looked already, and I think the chart we showed was maybe 30 or 40 basis points coming off of US GDP because of tariffs. And it could get a little bit worse than that, right? So maybe it gets a half a percentage point shaving off of GDP growth. And with respect to Doge, I think they are making what I'd consider to be, meaningful progress in spending cuts. And we don't know exactly what that looks like, but let's say it's on a 50 or $70 billion, which is kind of what they seem to be saying. But in the context of a $1.9 trillion deficit, I don't know that actually moves the needle that much from a deficit standpoint. From a growth standpoint, the overall size of the economy, kind of the same thing. Now, obviously, for those impacted by those cuts, it's very meaningful. And we are really looking closely at some of these higher frequency employment measures to see if we're seeing any impact, but especially in kind of that Virginia, DC area, in terms of initial jobless claims. So far, we haven't seen much of an uptick there, but it's still early, so we have to kind of wait and see how this plays out. I noticed there was an uptick in open houses, actually, new houses for sale, kind of in that Northern Virginia, DC area. So there's definitely some impact in terms of what Doge is doing. But again, it's too early to tell. And then I think the other thing I'd point out, and sorry to drone on like this, but I think about the sequence of things that the administration can accomplish. In the beginning part, it's executive orders. It's I'm not even sure what Doge is, to be honest. But there are certain things that the administration can get done via executive order, and those are more along the lines of say growth neutral, growth negative types of things, right? Second half of the year, potentially tax cuts and other stimulative measures, because those just take longer, right? There's more of a process to get there. So we're still super early in this, and I wouldn't necessarily judge that, because we're a month and a half in and we see kind of an anti-growth, high inflation and kind of direction to things, that's where we're going to end up, even a couple months down the line.
Yeah. And I see there's a whole host. First of all, thank you everyone for sending in your questions. I know we may not get to all of them, but we will sort of follow up on an after basis as well, in the interest of sort of keeping everyone's time. There are a couple of questions in here. A question around risk control strategy. Can we elaborate on this? Christian, I'm going to pass this one to you. But before doing so, in the fixed income side of things, there was a question around where should we be positioned in that yield curve? And, if you look at where the yield curve is, you're still getting paid reasonably well sitting in that short to intermediate stance. And so, yes, that does make sense as part of your overall portfolio. If you're sitting all in cash, and we know that there are investors sitting roughly $7 trillion is sitting in cash and money market funds. Now, this is where sort of balancing act, depending on your portfolio's time horizon, could step out of cash into some of that short to intermediate component. Balancing the two may make sense. Christian, do you want to elaborate on the risk control strategy that we referenced briefly in the call earlier?
Yeah, sure. I think the most common risk control strategies on the platform, I think the formal risk control strategy on the platform is Savos US Risk Control. That strategy has de-risked a fair bit over the last week. And it's interesting, and it's similar to the chart that Kezia talked about with credit spreads being quite well behaved in the face of a lot of policy uncertainty. The VIX was actually pretty well behaved. Up until earlier this week, it was sub 20 for a long time, and just recently, started spiking up in reaction to a lot of this, a lot of this trade chatter and, of course, market declines. So we just de-risked meaningfully in that portfolio. It's about 80% equities today. It was over 100% a few days ago. So in terms of managing the risk in the portfolio, we've really tamped down risk in that particular strategy.
Fantastic. I think we've gotten to most of the questions that we've had. We'll take a look at the chat and make sure that we haven't missed any, and may reach out to you personally as well. Christian, I'm hoping that we've conveyed there's a lot of uncertainty out there. Volatility will certainly be in the forefront. We've seen days of plus or minus 1.5 become sort of the norm in 2025. And for me, as a reminder, I go back to when we don't know exactly what lays ahead of us and we can't hedge out those risks, and this is why we have the premiums that we do in markets, a diversification, again, is sort of the sound principle we need to go back to for investors looking to what to do. So stay invested, make sure you're well diversified, rebalancing your portfolio within that S&P 500 away, just not being completely focused on those Mag 7 names, making sure you've got some of those large and mid caps as well. Within fixed income, making sure you've got quality bonds, not just sitting all in cash. And then from a risk management perspective, we talked about risk control strategies and or even alternatives as a portion of your portfolio. Anything else you'd wrap up here, Christian?
Yeah, I mean, I think just echoing your thoughts, and I would encourage everybody to keep an eye on the long game here. Again, as I kind of, was referencing, we're really early on. I know we've seen a lot of activity, but we're extremely early in terms of where I think we'll land on the policy front. So still very uncertain. And net, I think we kind of view the administration and still do as kind of a pro-growth, pro-inflation kind of, type of policy mix that we'll see. And that's not bad for, for risk assets, not bad for stock market, not bad for the bond market, in terms of where we are today. So just, try to keep an eye on the long game and stay invested. All right. Thanks everyone for joining our chat this afternoon. Appreciate the time. And if you have questions, please reach out to your RC. Thanks, Kezia.
Take care.